Hello, my name is David Mandy. I'm president of O&M Partners in New York. I want to welcome everyone today to our special event on the OTC markets. This event is brought to you by New York-based O&M Partners. For those of you who are new to our broadcasts, we're focused on bringing public companies and non-deal investors together in real time, providing context and helping investors make a better informed investment decision. But as I said, today we have a special event. This event is designed to demystify common misconceptions about listing on the OTC for both companies and investors. As we know, a lot of managements of public companies invest a lot of time, energy, and resources in trying to get the message to the right people at the right time, particularly in the non-deal markets. So what happens when a company, some investor decides they want to buy your stock, but then they find out that they can't? This event is designed to demystify common misconceptions about listing on the OTC. It's really for both company heads as well as investors, savvy investors. We want to answer all of your questions today. Feel free to you can text in your question on the GoToWebinar pane, or you can just email us. If you've dialed in today, you will not hear the presentation, the introductory presentation, which will be about 10 minutes, but you will hear the main presentation. So please stay on the call with us. Before we turn to our host, Chris King, Senior Vice President in International Corporate Services at the OTC. We're going to start with Doug Loud. Doug has 30 years experience in investigations, due diligence, compliance, anti-money laundering, financial reporting, and accounting. Doug has provided financial reporting and accounting consulting for a number of industries, including investment banking, corporate finance. Doug has a very deep background, and to give all the information would be impossible in one sitting, but the most important near term, the last 10 years, he served as compliance manager and executive director of Greystone Asset Management in New York. Greystone, he deals with issues related to international money transfers, security transactions, and anti-money laundering efforts. So there's Doug also has been known, he writes and also gives speeches on issues related to US citizens holding foreign assets. So without further ado, it's a real pleasure to turn the call over to Doug Loud.
Thank you, David. I've been asked to do an introduction for this OTC talk. And in order to do that for some of the listeners, we realize that in today's modern electronic world, everything appears to be going on instantaneously. You need to know, and bear this in mind, nothing is what it appears to be. It may appear to be electronic and instantaneous, but all of these transactions in the securities markets take place above a sea of paper. And a great deal of that paper is regulatory, and a great deal of the concerns in the markets are people who have to deal with those regulations or worry about dealing with those regulations. There are companies that issue shares of stock. Those are called the issuers. There are people who buy them, known as retail investors and hedge funds and people like that. And in between are a large number of organizations who are effectively invisible in today's world. But included in there are people like the Securities and Exchange Commission, FINRA. FINRA was formed by a consolidation of what we'll call the compliance departments of the New York Stock Exchange and the National Association of Securities Dealers back in 2007. And there was a little history required, so let me give you a little history before we get started. Basically, in the olden days, you've heard about people standing around under the buttonwood tree transacting in securities. Then they started having stock exchanges, and there's pictures of people standing on the steps trading securities. In Bermuda, in fact, to this day, I believe the stock market consists of guys standing on the steps of one of the buildings trading with each other. Anyway, as the stock markets came into existence and as people transacted in securities, things started to happen like somebody bought some shares. Somebody paid for those shares. Well, how did that actually physically happen? Well, in the olden days, Basically, what would happen would be that you sold your shares of Widget Corp, and a runner, a young person trying to join the firm, would take your stock certificates and run over to the firm that had been on the other side of your transaction, hand them the certificates. They would hand him the money for your certificates, and he would run back. This, of course, over time started to get more and more complicated and take more and more time. And so you may be aware of the idea that in reality, if you buy or sell a security, you actually have 3 days to deliver it. That's because in the olden days, they literally delivered certificates. Over time, they decided to get a little smarter, and they invented something called clearing and clearing firms. And those were firms that stood in the middle. So the runner basically only had to run as far as the clearing firm, deliver the certificates that went into the account of your firm. Meanwhile, somebody from another firm on the other side had delivered the money, and it went against their account. The transaction was marked cleared. You had now bought or sold the securities in question. This, of course, continued to get more and more complicated. And as a result, pretty soon large financial organizations became the clearing firms. For the longest time, that's all there was. You just cleared your trades and on it went. Then we had the financial crisis. And one of the things that came out of the financial crisis was the FINRA and the SEC looked at a lot of the transactions and decided that roughly 60% of the frauds came out of what they called little companies, which is to say basically companies under $300 million in market cap, or nano companies, which are companies under $80 million of market cap. And they were very concerned about this. So they decided that after all these bad transactions have been happening during the financial crisis, that what should happen is that clearing firms could no longer get away with clearing transactions just per se. The clearing firms now had to do due diligence on the transactions they were clearing. Well, that's a huge bureaucratic load for them to take on. So then it was decided that they didn't have to do that if the securities were traded on an exchange. Words to burn into your mind, like the American Stock Exchange, the New York Stock Exchange, the over-the-counter exchange, NASDAQ, several of these various kinds of exchanges. The problem is there are different levels of exchanges. And one of the things you have to watch out for is the fact that you may recall in the olden days, there were things called the pink sheets, for example, as I recall, or even blue sheets. But anyway, the idea was a stock that wasn't traded very often or on an exchange had its bid and ask price written down on sheets of paper called pink sheets because they were pink. And the pink sheets were circulated periodically. So if you wanted to buy and sell one of those shares, somebody had to find the pink sheet that listed that transaction, find out who was making a market in the transaction, go to them, execute your transaction, try to get it cleared. This over time got electrified as well and is there lurking in the background. You may feel as an investor that you can go in and buy whatever you'd like, wherever you'd like, but in reality, the pink sheets still exist in the forms of the lower level of what is known as the over-the-counter or OTC markets. There's then a level of OTC that a company, an issuer can graduate to called the QX. Once you're in the QX, the transactions are okay. But why does all this matter? Here's why. Remember the SEC and the regulations? Well, there's people in the world now called compliance officers, whole departments of compliance people. And their job is to make sure all the transactions are done in compliance. And one of the things that happens with a clearing firm is, because everything's happening so quickly, a transaction can be recorded and everyone thinks that the transaction is good. And then the clearing firm realizes, oh, wait a minute, this is one of those securities that isn't on an exchange. We don't want to be responsible for clearing this transaction and having done due diligence on that company. So what do? They send out a notice breaking the trade. This means the trade didn't happen. This can be very expensive. I'll give you one example from long ago and far away where we were involved, my firm was involved in a transaction with a firm we dealt with a lot, and they called up and they said, you can't do that transaction. And we said, why not? And they said, because part of the due diligence transaction consists of our having to find out who the auditors and the law firm are of the little company that you guys are trying to trade in. I, in my stupidity, of course, said, well, gee, why do you have to do that? And the lady laughed and said, Because, Doug, remember, nobody ever asked who Bernie Madoff's auditor was. Now we have to ask. They don't want that level of responsibility. The trade was broken, and in that particular instance, it was okay. So companies coming into the United States from overseas often sort of think they can come here, start marketing, and people will buy and sell their shares. It's not quite so easy because, as I've said, depending on where those shares are traded, the trade could be broken. Many companies, in fact, trading overseas are unaware that they have quotes in this country that are generated by people making a market in their securities and are in effect, in my opinion, in the equivalent of the pink sheets. And those trades could get broken. If my hypothetical elderly lady, Mrs. McGillicuddy, buys those shares, that trade is liable to get broken. On top of that, if a hedge fund decided to buy those trades, a sophisticated investor with a lot of money, that trade might possibly go through, and perhaps because the hedge fund is also clearing through the same clearing firm and they know it's a big solid firm. This adds a little more confusion to the entire issue, but you have to bear it in mind. Last but not least, we have the compliance people. The compliance people in the firm do not want to have trades broken because, after all, they don't want all the confusion in the bookkeeping department of the firm. So what do? They watch the trades go by, and they may break a trade before it ever gets to the clearing firms. And that is something else you have to watch out for. And last but not least, depending who you are as the buyer, the compliance department may decide that the security is unsuitable for you. There's my Mrs. McGillicuddy. We actually had a situation where for our Mrs. McGillicuddy, we had bought a bunch of shares. She just loved mining companies. She lived in Vancouver. She was American, and she was 80 years old. One day, compliance strolled in and said, all those mining stocks she has, we're not so sure we think those are appropriate for her. I don't want the SEC coming in here in 2 years and telling me she's got a big stack of inappropriate securities that are unsuitable for her and give us a bunch of demerits. So you have to sell all those securities. Fortunately, having a legal degree in my background and having dealt with lots of bureaucrats, I then asked, what if she wrote us a letter asking us to buy and sell these kinds of securities and instructing us specifically that that was what the purpose of her account was? Now that he had a document from the client, that would in turn make it okay. But otherwise, we would have had to sell out a number of very profitable positions, generating huge tax charges, all because various people in compliance, somewhat rightly so, were concerned about a federal agency possibly coming in the remote future to find out what kind of securities these clients had. Now, if you think all of this is a little complicated, but who cares? Let me tell you a horror story. What I'm about to tell you is a simple mathematical example, and then I'll tell you what really happened. In our simple example, a young stockbroker buys his grandmother, Mrs. McGillicuddy, 10,000 shares of Widget Corp at $1, $10,000. Okay, fine. This stock, however, was brought to market by Humpum, Dumpum, Thumpum, and Guffaw, and shortly thereafter, they pumped the stock up to about $5. The young broker thinks, oh, well, this is great. I'll sell the stock and make $4 for Mrs. McGillicuddy. He then proceeds to sell it. The stock, however, continues to run to 10. He's sort of regretting he hadn't held on. Well, unfortunately for him, what then happens is it turns out that the clearing firms decide this was an inappropriate trade, and they break the trade. So now Mrs. McGillicuddy did not own the shares at 1, but she had sold them at 5. The stock has now run to 10, and she is short 10,000 shares at $5. She's looking down the unpleasant end of a $50,000 call because she has to cover that trade. In the real world where this happened, a similar situation occurred, except the break occurred 2 weeks after the buy. The sale occurred about a week before they found out that the break had occurred, but the amount involved was $1 million. Therefore, when you are buying and selling various securities, you have to pay attention to where they're traded. The OTC wants to take very good care of you, and there are a lot of wonderful companies there, but you want to make sure that they're on the QX or above so your trades won't be broken. As our compliance department likes to put it, you brokers can blow yourselves out of the water. I don't care what you do, but if it isn't on a real exchange, I won't clear the trade. So you want to make sure you're buying and selling securities that can clear. And if you're going to sell something you have recently bought, make absolutely sure that your trade hasn't been broken, because somebody somewhere in some bureaucracy decided it was inappropriate for you. Listen well to what the people from the OTC are about to tell you, because it's a fascinating presentation they're about to make, and enjoy your day.
Thanks so much, Doug. Very helpful. Now we're going to turn to our host, Chris King. Chris is the Senior Vice President, International Corporate Services at the OTC. He leads the, he's personally responsible for helping more than 900 companies join the OTCQX and the OTCQB markets in the US. He began his tenure at OTC markets in 2014, working with the small cap US companies, helping them implement the best practices. It's a real pleasure to turn the call over to Chris.
Hi, good afternoon. First of all, a big thank you to all of you in attendance. I appreciate you giving me your time and attention. I don't plan on presenting slides for more than about 15 minutes, as I think the more interesting piece here is the Q&A and a bit of interaction. So please bear with me while I go through some of those slides. But especially a big thank you to David Mandy and his team at O&M. You know, there's a number of reasons why I was very keen to host this kind of a presentation with David. I think the synergy will come through as I go through some of the best practices, sort of shared philosophies around, you know, the efficient, cost-efficient and effective ways of telling your story to a broader audience of investors who ultimately want to trade the stock. So this afternoon, I'm going to cover off sort of three main themes. Hopefully all of them will be relevant to you if you have an investment proposition that you want to market to US investors. So it's really compliance with the US, and God bless America. There's 50 odd different sets of rules, one for every state and jurisdiction. It's trading solutions, and it's visibility. And all three, as Doug alluded to or mentioned at the start of the presentation, you know, visibility is great, and we encourage companies to take advantage of conferences and roadshows and all the traditional and maybe more modern ways of communicating to investors. But at the back end, a lot of that effort falls flat on its face unless you have an efficient trading mechanism to allow those trades to occur. So before I start sharing some of the slides, I thought it was worth just summarizing the business that we're operating here and the role that we play within the US for cross-border trading. If you think of us, or please think of us as a technology company, we are not a stock exchange, which simply means that we are not a regulator. And the thousands of companies that trade on our market every day from all over the world enjoy the benefits of having a stock exchange listing in their home country and continuing to be regulated and to disclose through their home markets. So I'll get on to some of the misconceptions around what I often hear. I think it's the fun part of my job is meeting with issuers. I used to think I had a sales job, but ultimately, if you wanted to join our markets, and specifically our QB, our venture market, or QX, our best market, I think understand, you know, it's a strategic decision. It's not one that I can make for you, but once we share some facts and do some of the myth busting around the misconceptions that I hear every single day from public companies, I think it becomes obvious as to the opportunity. And so it's great to partner with O&M, and hopefully you get some value out of the presentation. I'll open this up for Q&A shortly. So as a technology company, we are operating the largest trading platform in the US for US brokers that want to trade a variety of securities. There are more than 10,500 securities traded on our market every day. These take the form of about 3,000 companies who only trade on OTC. That includes hundreds of community banks, thousands of very small companies for whom a stock exchange listing would be too painful, complex, and costly. But the vast majority are companies, I assume, like most of you, who are public outside the US, and the thought of joining NASDAQ or NYSE is probably absurd. Certainly, in terms of secondary trading, it's the OTC markets platform that is really the cost-efficient mechanism to open the door for US trading flow. So the users of our market, on one side, you have the brokers. So this is who Doug was referring to. If you think about the brokers who quote NASDAQ and NYSE securities every day, they need a platform on which to create a transparent market on which to print shares that trade that aren't NASDAQ or NYSE. So, the brokers like Citadel and Knight, Virtue and Canaccord, some of the bigger names that quote thousands of securities, the reason why they use our platform is that it's our system that feeds all of the retail brokerage accounts throughout the US. So whether it's investors that use Schwab or Fidelity or E-Trade or Ameritrade, the reality is that the only reason that an investor is able to trade a foreign listed security electronically is because there's a broker posting a bid and an ask. So just in its very simplest form, if you are a Canadian resident and you want to buy Apple or Microsoft, you're not opening a US brokerage account and depositing US dollars into that and then trading NASDAQ NYSE. You're able to do so because someone, a broker somewhere, is enabling a bid and an ask price for those American shares. So just think of that in reverse. The role that we play, we operate the largest ATS, super ATS, which is alternative trading system in the US, that enables all the US brokers to quote and trade foreign securities. And then on the other side is the user. As I said, we feed all of the retail brokerage accounts. But the other users that a lot of companies want to access are American funds. So certainly smaller US funds, certainly the family offices, and in many cases in the nano, small or micro cap space, you're not knocking on Vanguard or BlackRock or State Street's door. And your primary market is the sophisticated, self-directed, high net worth investor who's likely to side with management over the longer term as you go through the growth of your company. And so, we play an integral role in facilitating and enabling those trades to take place. And so in partnership with an efficient marketing program, it's really getting onto the established markets, the premium markets, QB and QX, that will serve you well. So I'd love to hear from you and to continue a conversation or start a conversation. Most of the companies that trade on OTC, QB and QX tend to see a number of benefits. The end result being increased trading volume, enhanced liquidity, stronger valuations, lower cost of capital as a result, all on their home exchange. So before I just get to the next slide, I just wanted to provide you an idea as to what we'll talk about. It's best practice investor relations with efficient trading mechanism. You're not creating an additional class of share. You're not taking on, there's no SEC filing requirement to trade on our market. And we'll talk a little bit about what that looks like. So yeah, let's get to the common. That's not working. How do I do it? Okay, there we go. I remember. So the common misconceptions that I hear all the time, and I'll just whiz through these pretty quickly. A lot of them tend to be linked. So any institution can buy my shares because I'm public. Correct if you are a mega cap company or a large cap company, and it's the top tier institutions that are going to buy you. It would be insincere of me to sit here and say that Vanguard and BlackRock rely on OTC markets. They trade very large sums directly into most foreign markets, not all, but most, meaning that if Vanguard wants to take a position in a large cap company listed on the London Stock Exchange, they're going to trade direct into the London Stock Exchange. But as you work your way down and you start meeting with smaller funds who trade in US dollars and rely on trading in US market hours, it's our system that helps facilitate those trades. The second point there, US brokers and advisors can recommend or buy. I've used in this case Canadian, but you can apply the same to any non-US company. There's often an assumption by companies that because you're public, because you spend a lot of money being transparent and shareholder friendly in your home market and you're highly regulated, that anyone can buy your stock. That's factually incorrect. And the majority or a large number of smaller funds, you've probably heard this as you've traveled throughout the US, you'll probably get asked, when are you going to list here? When are you going to trade here? When are you going to get quoted here? The question may be asked in a number of ways, but the reason behind the question is, I need to trade you in US dollars. So again, it's our system that facilitates. I think that sort of really speaks to the third point as well. It's that the US quote that facilitates the trade, that ultimately feeds the volumes on the home exchanges. Remember, the shares all have to come from somewhere. So I'll talk a little bit about the settlement and the clearance and kind of how that looks. I think Doug alluded to many of the problems or the challenges, but just know that as I'm recommending that you consider QB and QX as a trading function, you know, a significant portion of our business is really built upon enabling brokers and advisors and investors to settle and clear a trade. It's not just having a quote. And so we do provide a compliance file to all of the major firms within the US, so that, you know, no one's, I think Douglas said it, no one is doing due diligence on 10,000 securities. It's just not the reality. And so it's our compliance file, and ultimately the tier of the market that you trade on that signals to the brokers and the settlement and the clearance firms who you are. And so you can be a wonderful company with lots of revenue and a high growth story, but if you're sitting on one of the lower tiers of the market, that's going to present challenges for you just by itself. The fourth point there, need to list on a US exchange for success. That's generally rhetoric spread by those that make money out of US listings. I'll just call it for what it is. The US exchanges are littered with very small companies who probably should not have taken that step, or perhaps just took the step too soon, and they shredded their shareholder value. Maybe they raised a little bit of money, but what was the cost of getting there? You know, being a liquid, being one of the smallest fish in a big pond, you're going to struggle with all of the same things that you struggle with before you dual list. So taking on SEC filing, Sarbanes-Oxley compliance, and all of the costs with the third-party advisors, I'm not saying it's not the right path for a lot of companies. It's just something to consider when here we are operating a trading system that is designed to continually provide access for all secondary trading into foreign exchanges. The next check box there, or the cross, talks a little bit about pink and gray. I'll elaborate on what pink and gray is, but I think the key takeaway to this point is that neither are okay. Gray suggests that there's a market there. People call it the gray market. But what gray means is that there is
Chris, are you there? Could you hear us? Sorry, Chris, you may have lost your audio.
security. I'll just
You're
repeat that. I've got a note saying the audio connection is just restored. Gray market is not good for a company because it means that there are zero brokers in the US posting a quote in the US. And so if there's no quote, if there's no bid and no ask, you don't have a market. It's almost trading by appointment, like Doug mentioned in the old days, where, say the old days, 20 years ago, where there was no electronic market for this. If someone called their broker and harassed them hard enough, the broker would then have to obtain best price. So now they're making multiple calls to different market makers. And then ultimately that trade may not go through for a variety of reasons. So gray is just completely inefficient. Pink is certainly better. Pink suggests, well, pink says that there may well be a quote being provided. But the pink market is what it's always been. Most people have an opinion as to what pink means, but it's the bottom market tier for a reason. There's no application process, there's no ongoing verification, there's no fee from the transfer agent about shares outstanding. If you're bankrupt in the US, you get kicked off a US exchange, you get put on the pink market. If you trade at fractions of a penny, you have to trade on pink. So in addition to what Doug mentioned around trades breaking down and inefficiencies, pink, means that you as a company have no link to the OTC markets. It means as an issuer, your stories, your news flow, your investment proposition, your financials are not being efficiently redistributed and nothing's posted on our system. And so to the extent that pink just represents a red flag for a lot of the clearance firms, again, no one's doing due diligence on you. And so if you're coming across as pink, then it potentially suggests that there's going to be trading issues. And just to be factual, our QB, which is our venture market, and QX, which is the top market tier, we see substantial increases to trading flow on both sides of the border when companies upgrade and, of course, continue to tell their story in a variety of ways. The final 2 points I'll just whiz through quickly. The SEC filing requirement, a lot of people, seems like you approach, if I approach a company at a Canadian, I don't know, like the mining and prospecting conferences, VRIC and PDAC, for example, you start talking about the US and you can see visually there's this sort of barrier that goes up and no one wants a second regulator, no one wants to be SEC filing. And I can understand why, but ultimately you are able to cross trade onto our market out of other countries by way of an SEC exemption. So I'll speak to that later. And then finally, and this speaks to some of the compliance function that we provide, the fact that each state in the US has its own set of rules designed to protect the residents of those states means that you, as a non-US issuer, won't naturally be afforded the luxury of meeting those blue sky exemptions. So if you expect or hope that brokers will be able to go out and buy your stock on behalf of their client base who perhaps reside in Texas or Virginia or Ohio or wherever it might be, guess what? You have to meet the needs of each state, otherwise you're blocked out. And so as market operator, we've really built tiers of the market to provide solutions for all of this. And I'll speak to blue sky and exemptions in a few minutes, but to suffice to say that joining our market is more than just getting a ticker symbol. So I've actually mentioned quite a bit of this already, but we are highly regulated. It's a point that's worth reiterating. We're SEC registered, FINRA regulated. So FINRA is the financial regulatory authority in the US. What you're seeing here is level 2 quotes. It's one of the features that I thought was worth a quick mention. In fact, I have a QB client that I will link to just now, as I happen to be browsing this afternoon. So this is a company that is certainly, you could argue, is in the nano cap space, traded outside the US. And I was curious just to take a look at what the depth of book was, what the liquidity is. Just having a quotation on pink, all you would see is a bid price. You wouldn't see the depth of the book, which says that you've got G1 or E-Trade here, you've got our ECN just beneath it, you've got Virtue just beneath that. What these brokers are doing, and why QB and QX and transparency is useful for the investors, is that I know I can buy 28,000 shares, or sell, I'll go to the buy. I can buy 10,000 shares at 5.65 cents. I now know that there's another broker behind that offering another 11,000 shares at the same price. And then at fractions of a penny behind that, I can see that there's thousands more, there's 50,000 through FC Stone. So for many people, they don't think about what the investor goes through before being able to transact in a trade. If I just put through an order for X amount of shares because I don't have access to this information, which you don't on the pink market, that trade's just going to get kicked back. It'll be a limit order where come end of trading day, I find out that my trade didn't go through because the price that I was putting through and the size that I put through didn't get met. So that's just another example of features that are important for trading. QX is where you'll find companies like Roche. So that's our largest client at 275 billion in market cap. Heineken, Adidas, Hugo Boss, BASF, the list goes on and on. I would not think of QX as a mega cap market. We use those names to create comfort that this has been reviewed intensely by lawyers all over the globe, and these companies have determined, look, they can trade anywhere in the US, they qualify for any exchange, but for the sake of secondary trading, they get all the access and secondary trading that they need throughout the US every day on the QX market. QX comes with visibility platforms or series. We do market opens, we do virtual conferences. QB is our venture market, where we have hundreds of companies, certainly out of Canada, that see QB as almost a box checking exercise. They go public in Canada, they have to access the US market. They want to do it in an efficient way. The eligibility standards on QX are to the point where there's no penny stocks. You have to have certain market cap and share price. And that's not about status or prestige. That is about finding ways that allows more brokers to participate in a security. QX comes with blue sky exemptions, QB comes with blue sky exemptions, but QB rules are really written for the smaller cap companies so that you have a healthy environment on which to trade, get your visibility and go out and market your story. Whereas, as I said, Pink doesn't have any financial standards, or there's a variety of different types of companies that trade there, including those bankrupt and shell companies that I mentioned. In the interest of time, I'll just go through some of these rather quickly, but I can share all of this with you. I can have it emailed to you afterwards. I think this is a pretty good slide because it outlines, what your options are. On the left-hand side, you can see that listing on a US exchange when you're already public in Canada, questionable for most companies. I can tell you that the primary listing in Canada becomes secondary. Now you're taking on the burden of being listed in the US. The trade volume gets sapped out of the home market and the primary becomes the US, but you're not necessarily getting the return on the investment, aside from having to commit more time and effort to compliance and Sarbanes-Oxley and all the things that actually led to a lot of mega cap companies all over the world delisting off the US exchanges when Sarbanes-Oxley was introduced. On the right hand side, and I think this is an important point to take away from the entire presentation, is that you only have one stock exchange. Your primary listing, if you're listed in Canada, remains in Canada. Your reporting and disclosure continues to be what it is. But when I said earlier that the shares have to come from somewhere, if a broker in the US use your QX or your QB status or ticker to take an order, let's say Chris King logs onto his Ameritrade account and buys company ABC in Canada, 10,000 shares. I don't care about the plumbing or how any of it works. I just want the 10,000 shares. So I have an efficient market, I have price, I have visibility into that. I know that I'm going to get the shares. I put the buy order through, the broker gives me the shares. That broker is very unlikely to be sitting on your stock. And so the broker goes short to give me the 10,000 shares, but in that same moment, they're going to go cross-border in most cases into Canada in this example, and they're going to obtain the 10,000 shares. So that as a trade actually just increases the volumes on the home market, and you get all of the benefit of that. It's one of the reasons why, I think a quote down in the left-hand corner here, we have a great relationship with many of the stock exchanges, but certainly the Canadian Securities Exchange is an example of, an aggressively growing exchange, one of the fastest growing exchanges in the world, I would say. But they were quick to understand the business model. Stock exchanges love our business model because when you create demand and the facility to execute on trades out of the US, you're getting all that US trading flow. The shares have to come from somewhere. So it actually, you get happy issuers and a lot better liquidity. But in most cases, you see far greater volumes on the home exchange. In some cases, you also see substantial increases to the trade volumes printing here. But I can tell you from experience that most brokers don't sit on stock in the US. They only have to print here if it's a US to US transaction. So if a broker's going into Canada to settle and clear, that's where the volume gets printed. Quick summary here of an academic study that was carried out towards the end of last year. No surprises. You put these kind of facilities in place, and I'll reiterate, you continue to tell your story through a number of methods. You know, we have personally found that the virtual conference platform we operate has tremendous value for our issuers. And the reason why, you know, I wanted to partner with O&M and educate through this facility is, again, the philosophy that, you know, control your message, market in a thoughtful way. You know, we see stock promotion of all types, working with companies in more than 30 countries, and we have to deal with that. So we have a promotion policy, but when you work with a reputable firm that's been doing this for many years and has an experience in terms of helping companies tell their story, having the trading platform in place that helps facilitate the trades only serves issuers better. And that's why we wanted to get together and kind of go through this subject matter. I really see our business as trading and compliance, and whilst we do provide some visibility functions, you know, we encourage companies to do an awful lot more when they can. So I'll just finally just go through a couple of screenshots that will help you visualize or help you see some of the things I've alluded to. Ivanhoe Mines has been incredibly successful on our QX market. This is a screenshot of my US brokerage account. So what do I see? I type in Ivanhoe Mines into my brokerage account, and the only ticker that comes up is this 5-letter ticker ending in F for foreign. This indicates that I'm now, you can see QX in tiny letters here. So this is not something that's important to us. It's important to the brokers who recognize the market tiers. So I know I'm buying the ordinary share of an F, a foreign listed company or a non-US listed company. You can see, actually the market was closed when I took this, so that's probably not the best example. But here's an example of a company on the opposite end of the spectrum, right? So I'm not picking on this one for any reason in particular other than they're on gray. There's no inside bid, there's no offer. So the fact that there's a share price means absolutely nothing if there's no public quote. You can see there's a warning here just advising that there is no broker in the US providing a trading function. You can see as well, so same company, but again, in the brokerage account, this is the OTC market site, but this is a brokerage account, so I don't know what the bid and the ask is. When I went to that same company's financials, there's nothing there. I then click on, so this is actually a pink company. So Torex Gold trades on pink, but there's no news for me to be able to consume. So now I'm forced to go to other company or issuer websites to try and figure out whether this is an investment I want to make. Back to white gold, this is their blue sky compliance map. You can see Texas is out of compliance, most of the US is white. There's not a UBS or a JP Morgan or a Merrill or any wealth management firm that's going to be able to trade this stock on behalf of their clients unless you live in Louisiana, or New York obviously is important, as are some of these, but I dare say Delaware doesn't bring too much bang for the buck. So this is Ivanhoe Mines. Again, you join QX, you get the exemptions in the majority of states. We've actually just added Virginia, so we're getting closer to all 50. Then I just wanted to demonstrate, you saw the blank screens on the pink and the gray companies. Now you see Ivanhoe, they're using our system. They're actually one of the best performing companies. They've been a member since 2016, but you can see, right, there's all the news that I need as an investor to make an investment decision. We do operate virtual investor conferences. These are different to the O&M webinars. Here, what we're looking to accomplish is giving our clients access to a broad investor base alongside peers. So it's like a traditional conference with the exception that the presenter sits at home. Again, I do encourage companies to take advantage of as many opportunities to get in front of investors, clear and consistent communication, be factual, control your message, etc. It's really common sense and best practice IR. But you know, I see certainly in the last few years more and more companies that are convinced by use of social media as really the platform on which they rely. And the trouble is you lose control of the message. There's often confusion, maybe deliberately in some cases, around who's responsible for promoting a story using social media and emails. And so as a result, the company loses control of the message. You see pictures of rockets going to moons, don't think, just buy. And so that obviously doesn't feed into the philosophy that we're looking to promote here. So I will spare you the last few slides just because I wanted to open this up for Q&A. And so I will wrap things up and turn this over to the callers.
Thank you, Chris. Great presentation. Learned a lot from you. We'll start today with Jeff Masseri, who knows a lot about this area. And please specify if you'd like to ask Doug Loud a question, who did our introduction. Jeff?
Yes, hi. Hello, Chris. How are you?
Hi, Jeff. I'm good. Thank you.
Great presentation. I'd like to just clarify a few things because I've been told, and I'd like you to clarify whether it's correct or not, that the difference between the QX and the QB is that the QX is a recognized exchange, and therefore a lot of clearing agents can clear stock traded on there. And the QB is considered by the SEC and FINRA as a marketplace, not an exchange, and therefore that's why they sometimes break the trade if it's a QB.
Great question. I'm going to add that to my list of misconceptions. So both QB and QX are considered by, so I'll use lawyer terminology. Both the QB and QX are considered established public markets. So that brings with it a variety of benefits, not least the ability to use your public price as a vehicle to raise money. QX, QB, and Pink are all tiers of the same trading platform. So the trading platform is not an exchange. It's considered, the formal terminology is ATS, or Alternative Trading System. Very highly regulated, and just for emphasis, we sit in the same room and held to the same standards as NASDAQ and NYSE when it comes to SRI, so regulation and integrity. So very high standards. None of our tiers are an exchange model for two key reasons. The first is an exchange is a regulator. We are not. And the other one is just the simple function of how trades are pushed through. An exchange is a matching engine. And so where there's high volumes for bigger companies, that works very well. For smaller companies that tend to suffer from a lack of liquidity, it's actually our business model, which is a broker-dealer platform, a quotation platform, where there's real traders actually creating the liquidity and creating tighter spreads that are responsible for the success. So the answer to your question is neither QB nor QX are exchanges. It is fair to say that QX having higher eligibility standards does feed into the idea that brokers take the compliance feed very seriously and they will act upon it. QX has the closest to an exchange trading model as you can get without joining an exchange, because there's no penny stocks, there's higher standards, bigger, more established companies with stronger balance sheets. QB, I've seen QB used tremendously well by thousands of companies over the last 5 years. Some of them continue to grow and they go up the food chain and ultimately may uplist at some point if it's necessary. But QB is an extremely efficient mechanism that is extremely liquid. So I wouldn't be concerned with settlement there.
Thank you. Great answer.
Thank you, Jeff. Really appreciate your asking a question. Let us turn to Chesley Morton. Chesley, question today.
Thank you, David. And it's always interesting to hear presentations such as this. I trade a good number of Canadian mining stocks, and it's always been frustrating for me trying to do executions in the US because it doesn't seem like the US markets are as efficient as, say, the venture or the Toronto, the senior market. And I've had to actually direct transactions occasionally to Canada. I was wondering if there were probably with your platform, there's a way of addressing that, but also didn't know if opening up cross-border trades more readily to arbitrageurs would tighten up that market.
So yes, the vast majority of companies, so if a company is already public in Canada, and you can apply this across most countries, if you're already public, then by engaging with OTC markets, setting up a ticker symbol, joining QB or QX, and in some cases setting up DTC eligibility, which just helps with electronic settlement here in the States, with all of those things, that would actually switch on the lights and remove that frustration that you've been experiencing.
Okay, then. So probably what I'm actually experiencing is something like a NASDAQ or one of the lower tier platforms that just is inefficient beyond just the differences in the currency.
Yes.
And, yeah,
so there
and
are.
I think it also has to do with volume of trades. The spreads, and I think you even showed some of that, spreads widen up with low volume.
Yes. So it depends on a company's situation. If you're highly illiquid on your home market, and just switching the lights on here isn't going to fix that. But being on QBQX, being set up properly certainly involves having brokers that are prepared to quote the security. And by posting quotes on our system, that ultimately feeds into whichever trading platform you use. And so you would see level 2 quotes, you would see the bid and the ask, and you would see the volumes that you could buy at what price. So once you put that order through, that in all cases is going to go through, unless you're trading perhaps the gray or the pink market. That's where some of the bottlenecks come in.
And then just finally, I think for a while we were seeing a consolidation between national exchanges. I think Canada went through that when they closed down Vancouver and rolled most of that into the Toronto, and they had the venture, but now they've started a few new exchanges. Here in the United States, we've even had an Atlanta stock exchange at one time, and they tend to pop up from time to time. Where's the trend going on that? Is it for more of those smaller exchanges, or are you one of the consolidators?
I think for us personally, we feel our business model is particularly unique. Yes, you see a number of exchanges or the desire from groups to create more exchanges, but a lot of these, the NASDAQ and NYSE have very wide moats, as does OTC. And so whilst from a pricing perspective and a trading perspective, we are seeing trades executed in different venues, the OTC markets is particularly unique, which makes it a fun place to work for sure. But the gap that we fill is unique in itself, right? So if you think about my department, which is corporate services, and you might call it a listings business, it's not a listing. So for you lawyers listening, it's not a listing, of course, but it's the most cost-efficient way for issuers that are already public to cross-trade in the US. So I haven't seen any sort of competitive models coming in, but who knows?
Okay, and then one last one. I don't want to take up too much, but are the solely electronic exchanges more susceptible to flash crash situations?
I think all technologies in the trading world are susceptible. I can only really talk from my perspective. We saw a handful of trading halts a few weeks back, which was not OTC specific. It was across all markets, and it was deliberately done. But I will knock on wood, but our trading mechanism is robust, and our goal is 100% uptime, and it's something that we're proud to have accomplished for a long time.
Thank you for your presentation.
Thank you.
Thank you, Chesley. I just wanted to remind people who are in our audience, if you raise your hand, we'll certainly come to you for a question. I want to try Mickey Fulp. Mickey, you're on the line with us. Do you have a question today?
I do. Chris, I am an exploration and mining analyst, and I hesitate to call myself a professional investor because these are professional speculations. That said, I have a number of clients who I always encourage to get OTC QB listings. Can you tell me the requirements for them to graduate to QX listings? I've had that occur more than once, and I'm unclear what thresholds they need to get to be able to upgrade their listing.
Yes, so thank you for the question. The three main criteria that companies need to meet to qualify for QX would be share price, which is a 25-cent US minimum requirement. There's a market cap requirement of 10 million. And the third one, which is really, I think, one of the key, it was painful when we introduced it because it really ruled out a lot of the great quality companies, the smaller companies that we would have been working with for QX otherwise. But one of the reasons why QX trades as heavily as it does per security is not about the size of the companies that are there. It's about having a no penny stock rule. And so the penny stock rule is the SEC's definition. It's either having revenues above 18 million over a 3-year period, or having net tangible assets above 5 million on an audited balance sheet if the company has been in operations for less than 3 years. If the company has been in operation for more than 3 years, it's just $2 million of net tangible assets on an audited balance sheet. There's one other, which is share price related. I'm guessing very few companies on this presentation perhaps meet the standard. It's the one that most people refer to and the one that's kind of kicked around as the penny stock rule, which is not factually accurate, which is the $5. There's a whole bunch of criteria under that $5 you also need to meet, but it's irrelevant. If you meet the net tangible asset or the revenue test, you can still join QX.
Okay, thank you.
Thanks, Mickey, as always. Doug Loud gave us that wonderful introduction. Doug, anything you'd like to add?
Yes, another possible one for your list. It's my understanding that companies coming onto the QB and the QX do not have to comply with Sarbanes-Oxley, of which they're terrified, if they're traded on an exchange in another country. Is that correct?
It is. The exemption is 12G32B. It's an SEC rule, which basically says, if you're listed on what we call a qualified foreign exchange, you're current in your filings, you produce your disclosure in English, you post that to your website, and you don't have a pre-existing SEC filing requirement, then you almost certainly meet that exemption.
So the other question I had is, you're trading along happily on the QB, you meet the requirements you just mentioned for the QX. What do you do to get to the QX?
We try and keep it simple. It's not a lengthy process. So we would be having conversations around your strategy and involving you in a variety of visibility function anyway. And so as we start to, we're sort of at that time of year now where companies are producing their financials. And so typically having that so either you meet the share price criteria and you had the tangible assets anyway, or perhaps you're about to produce financials that reflect the net tangible assets, we would have the company fill out an application form. Of course, a lot of that is per the QB subscription or membership anyway. And so it's not a lengthy process. It takes a couple of weeks. We try and make it as simple as possible, and costs shouldn't be prohibitive, but we'll often wrap in, we'll often take the existing QB membership and roll that into the QB invoice. And so you're not out of pocket no matter what time of year you decide to upgrade.
Great, thank you very much. Very interesting, very helpful. I'm glad
Thanks,
I didn't do too many.
Thanks, Doug. We really appreciated your participation. We'll turn to Scott Edmonds. Scott, questions from our audience?
Yeah, we have one, and I think I got this right. What do your conference calls cost, the ones that you were referencing?
So the virtual conferences, it was a platform that we acquired. We acquired it several years ago from what was PR Newswire. And so, you know, we just see great value, just like with O&M, right? The ability to push audio and slides over the web is not unique. What makes these kind of high value products unique is the audience, the attendees, having insight into that attendance. So the short answer to your question is on QX, we only charge, it's $1,000 for an event. QB, it does get discounted, but not quite as much as the QX. I think it's about $2,750. But what we typically see companies doing is they stick to their typical investor relations program. And so by that, I mean, they're going to attend a handful of conferences here. So it might be, you know, the Denver Forum, it might be PDAC or VRIC or, you know, the microcap conferences throughout the US. So that's your in-person meetings. And then we know the US is geographically challenging anyway. And so the ability for someone to sit at their desk like I am today and have the benefit of speaking to everyone on the event today, you know, that's tremendously useful. It gives you the opportunity to update investors, to build your target lists or the list of people that you want to continue engaging with. And so the point of that diatribe is that there's not one particular product or forum that is going to allow you to accomplish all your goals. We like to partner with, like I said at the beginning, sophisticated, thoughtful, and trusted partners that ultimately all have the one goal. Our goal here is visibility and trading. And so, you know, again, we're not strategic advisors. We don't focus on any aspect in particular, but we'd love to engage with more issuers for these purposes.
Thank you.
Thank you, Scott. I guess we've gotten everybody's questions. So I'm going to turn to you, Chris, for your closing thoughts.
Closing thoughts. Well, again, first of all, thanks to everyone. Thanks for David, you and your team for organizing. You've been extremely professional. I have been speaking with a number of companies listed in Canada who have either experienced working with you or are thinking of working with you. And, you know, I look forward to speaking to anyone who's attended this event. And yeah, just putting best foot forward in terms of marketing the issuer's story. So thank you to everyone for your time. And if you have any questions, my contact information's on the slide deck there.
Thank you, Chris. Thank you, Doug Woud. And of course, we will help, glad to help put you in touch with Chris King if anyone needs that help. I wish you all a very pleasant evening, and I really appreciate your attendance today. I hope you found it enlightening. Take good care.
Thanks, guys. Be well.